Hello? Is Tesla a buy now? That's a difficult question. Hello? Tesla, Tesla's a tough one because it's already increased so much in the last year. I mean, if you look to January of last year, it was $100 split adjusted. Well, not split adjusted. Now it's $800 a share. So it's difficult to get in now, but if you believe in the long-term vision for Tesla, which I do, which is that Tesla is aligned with the direction that we're going, which is going to be way more electric vehicles, self-driving vehicles. There's a lot of talks that people think that Tesla is ahead of the curve in that arena. So if you believe in those things, then yeah, go for it. My best advice would probably be to buy it over time, because maybe you buy it now and then Tesla crashes. It would not surprise me to see a big correction since it has increased so much. But my philosophy is to purchase things that you believe in over time and frequently. So that's kind of the Warren Buffett approach. This is tough for me. I've never done a live stream. There's so many comments. Thanks everyone for coming in. Let's see. Any low risk, high reward specific examples you have your eye on now? Bitcoin. Is Tesla going to split again? I don't think Tesla is going to split again until it gets back to whatever, 2,000, 2,500, maybe before then. The better question is, when is Amazon going to split? What is the best profit target for iron butterfly strategies for monthly income? The best profit target for iron butterflies. So the thing with iron butterfly is the profit zone is very narrow. So the profit component of an iron butterfly, when you're selling an iron butterfly, is the short straddle. And typically you get the most profitability from a short straddle very close to expiration. So let's say if you sell a 60-day iron butterfly, it would be unreasonable to go for a 50% profit target unless you're planning to hold it basically until the last week of expiration. So with butterfly strategies, I think you have to go for much smaller profit targets. If you're trading, let's say, a 30 or 60-day butterfly, then I think you have to go for 5%, 10%, 15%, something like that. But the longer you hold a butterfly position, meaning the closer it gets to expiration, assuming the stock price is within that tent, then you will see rapid increases in your profitability as those final days before expiration pass. Let's see. Been in plug for a while. Any good ways to play it now after such a big run up? Let's take a look. I'm going to see if I can share my screen here. Plug. Honestly, I haven't really traded plug. So if you have a position in plug and it is highly profitable and you've been in it for a while, I think that the way you can think about it is you can use some of your profitability in that position and you can protect yourself by purchasing a put. That's kind of exactly what I've been doing in Tesla. So I have a very profitable Tesla position right now. And what I've been doing is I've been purchasing put options as Tesla continues to run up. So yesterday I did a video on how to fill trades, and one of the things that I talked about was my recent roll up in my Tesla put. And the reason I rolled up the put is because I had previously purchased a put to protect against a decline in Tesla shares. But since Tesla was continuing to rise, I actually was getting more and more profits from that position. And I decided to roll up the put to get better protection. So I think yesterday in the video, I rolled up the 500 put to the 650 put. So I rolled it up 150 points, and I paid $2,800 to do that. But I'm completely fine with that protection, because if Tesla does come back down, that 650 put is going to be much better protection than the 500 put was. And since the position is so profitable, I'm not concerned with losing the $2,800. If I lose the $2,800, that's a good thing. That means Tesla continues to go up. So I think if you're in a position like this where you've kind of ridden the wave and you have a very profitable position, one of the things that I like to do is just purchase a put option out of the money. I would go probably 60 days out, maybe longer. I mean, obviously, the longer you go out, the more you're going to have to pay for that protection. So it's really up to you, depending on how much you want to spend. But one of the things I like to do is, if I have a really profitable position, whether it's stock or options or a combination, which is what I have in Tesla, then I will purchase a put option to mitigate losses if the stock corrects. Because what I don't want to see is, I don't want to see a really profitable position turn into a losing position. And once you have a really profitable position, you can afford to spend some money to protect that position. Let's see. Sorry, oh shit. Bitcoin just hit 40K. Let's go. Buying in the money call or put, let the stock run with the strategy. Is Ethereum a buy now? I'm not sure. I'm focusing on Bitcoin. That's the one that I'm more familiar with. I've spent so much time learning about Bitcoin that I don't know. I don't see, there's a lot to learn with all the different altcoins. And to be honest, I'm not super familiar with all of them, but I understand Bitcoin. I understand what it represents and what it could be. And I've read a lot of analysis from other people about Bitcoin, and Bitcoin seems like the most straightforward to me. A lot of the altcoins, sure, they could do very well. I think Ethereum will do very well with Bitcoin, but personally, I need to learn more about Ethereum. Right now, I'm just holding Bitcoin. MicroStrategy. Someone asked about MicroStrategy. So MicroStrategy, I do have a trade in MicroStrategy, and it was a Bitcoin play, because for those of you who don't know, MicroStrategy is a company that came out and they said, we are putting all of our cash into Bitcoin. So all the cash that's on their balance sheet, they put it into Bitcoin. And obviously you can see what happened here with MicroStrategy stock. Essentially, MicroStrategy at this point is a play on Bitcoin, because as Bitcoin continues to go up, MicroStrategy will continue to go up as well, because they own Bitcoin. So the valuation of MicroStrategy stock is going to take into account the value of their Bitcoin position. And they put $500 million into Bitcoin. And this was a couple months ago when Bitcoin was 10, 15,000. I don't know their average cost basis, but they put $500 million into Bitcoin. And now Bitcoin just hit 40K. And so you can see what happened to their stock price. So one thing that I did, which was just kind of a fun play, is I purchased the first thing I did was I purchased these 330, 400 call spreads, which are now deep in the money. And I actually did this after there was already a run up. So if we go to the chart, 330 is somewhere around here. So I actually got into this position after it already ran up. But what's actually really unfortunate is I tried to buy MicroStrategy call options earlier before this massive run up, but I didn't get filled on my trades. And so I actually missed out on a lot of profits because I would have had naked call options in MicroStrategy a little earlier in this run up. But instead of buying outright call options after the run up, one thing that I did was I purchased call spreads. And my strategy there was I would have less risk purchasing call spreads than I would purchasing call options by themselves. And my strategy was if I saw MicroStrategy collapse after I bought those call spreads, then I would have a profit on the short call portion of those call spreads. Because if I buy a call and I short a call, if the stock price goes down, I'll lose money on the long calls, but I'll make money on the short calls. So my strategy was, okay, if MicroStrategy goes up, then I'll still make money on the call spreads. But if MicroStrategy goes down, then I'm going to try to close those short calls and then keep the long calls in anticipation of another run up. So this was a high conviction Bitcoin play. And as you can see here, MicroStrategy is at 540. And another thing that I did was I actually did buy a naked call. So I bought this call for $78, which is $7,800. And now it's at 22.9. So $23,000. So this naked call right here is up $15,000 and it's only been open for a month. So this is going really, really well. One thing you'll notice is that these are in long-term expiration cycles. So this is a 344-day expiration. So I like to go, if I'm doing a very directional play, which is these days, I'm basically focused on bullish plays just because since I've been trading options over the last 7 years, I have learned that the market highly favors the upside, especially with all the intervention from the government. And so I think the public is very confident in the stock market. Obviously, it could crash. I mean, we saw a big collapse, but I think that you'll have better chances of making money if you focus on bullish plays, optimistic plays, as opposed to trying to bet against everything. But for these really directional plays, I like to go far out in time and I like to go out of the money. So I bought these a month ago. I bought the 500 call. Where was MicroStrategy a month ago? Let's see. Today is 1/7. Where was it? 12/7. So I bought the 500 calls when MicroStrategy was around 330. So I bought really out of the money calls, but I went far out in time as well because I wanted to give myself time to be right. Sorry, guys. I'm not going to be able to answer all these questions. I'm kind of picking the questions that I have some things to say about, and then I go from there. Let's see here. If I don't get to your question, just re-ask the question because I'm going to just keep scrolling to the bottom and then go from there. Thoughts on playing 0 DTE SPX credit spreads? So Rodney is asking, what are your thoughts on doing 0 day to expiration SPX credit spreads? So basically it's what we call a binary event, meaning you're either going to be right or you're going to be wrong. Let's go to SPX. So if I were to trade a 1 day SPX credit spread, I mean, this is basically a 0 DTE play. I don't necessarily like these plays because, like I said, you really don't have any room to be wrong. And what I really don't like about SPX plays, particularly the standard monthly cycles, I think the weekly settle at a different time, but these standard monthly SPX options, they actually settle in the morning and they settle to something called SET. And SET is just a number that comes out on the morning of SPX settlement. And they basically take the opening price of all of the different SPX stocks. And then they use all of those opening prices in a calculation to get SET. And then they value the SPX options based on SET. The problem with this is the stocks all don't open at the same time. They don't all get their opening print at the same time. And so what can happen is you can have an SET number that is a value where SPX never traded. So for example, let's say I shorted the 3,800 3795 put. So let's say I did the this put spread right here. If I was holding this and this was the morning of expiration, basically I would have to hold this overnight, and on the morning of settlement, SET would come out, and let's say SPX opened at 3803. And based on the SPX opening price of 3803, you would think that this put spread would go out worthless and I would make the full profit. Unfortunately, what happens sometimes is SPX might actually open at 3803, but then SET, which is the SPX options settlement number that these options get their final valuations from, that number might come out at 3785, even though SPX opened at 3803. So the SET number can sometimes vary significantly from where SPX actually opened. And for that reason, you can have really nasty surprises when you're trading 0 DTE SPX spreads, because as I just said, sometimes SPX will open at a favorable price for whatever strategy you're trading. But then SET, which is the number that the options are actually priced to and get their final valuations from, that number can vary significantly from where SPX actually traded. And for that reason, you can have some really unfortunate surprises. And for that reason, I do not like, and I would not recommend 0 DTE SPX strategies. But if you want to go for it, by all means, that's you. Why would you buy long expiry out of the money when you can buy in the money? That's a good question. And the reason is cost. So if we go to, let's just go to Tesla. This person is asking, why would I buy, let's go to March 2023. They're saying, why would I buy a long dated, let's say 1200 call when I could buy a in the money call? So if I want to buy this 800 day 1200 call in Tesla, I'll have to pay $25,000 for this, because this is an option that's valued at $250. And if we multiply that by 100, we get a cost or maximum loss potential of $25,000. If instead I wanted to buy an in the money option, let's say the 500 option, then I would have to buy this 500 call for $44,000. So it's twice as expensive. So the reason I like to go out of the money, and this is only when I have a strong conviction of a directional movement that I will go out of the money. I'm not going to always just buy out of the money calls in every stock that I like, but on the stocks that I do, I like to go out of the money because you get more leverage. And what I mean by that is you pay less for the same exposure. And if Tesla goes up as it has been, you are going to have a much higher percentage return on the out of the money call option compared to an in the money call. But if you do go in the money, you will have more directional exposure right away. So for example, if I bought this 500 call in March of 2023, then the delta on this is 0.84. So that means that this option is expected to increase by 84 cents for a $1 increase in Tesla. So if I bought this call, then I would be expected to make $85 if Tesla went up $1. Now, if we go back to the 1200 call, the delta on this is 0.58, which means I would only be expected to make $58 if Tesla went up $1 after purchasing the 1200 call. But the reason that I like buying out of the money calls, and a lot of traders like buying out of the money calls, is because of gamma. So as Tesla increases, the delta or the directional exposure of this call option is going to increase. Okay. So if I buy this 1200 call and it has a delta of 0.58 and Tesla continues to increase, then this delta is going to increase towards 1, meaning it's going to get closer and closer to a stock position equivalent of 100 shares. So basically, when you're buying an out of the money call option, you're buying a call option that is currently less sensitive to a $1 change in the stock price compared to a in the money call option, which is closer to a share position of 100 shares. But since you're taking that extra risk by going out of the money and requiring a stock price increase, then you have the advantage of seeing this position get more and more directional as it moves in your favor. So if we can imagine a scenario where I buy this 1200 call, currently the delta is 0.58. For the first $1 increase, I'm expected to make $58. But let's say Tesla goes to 1,000, and let's say that this delta goes to 0.75. Well, for the next $1 increase, I will make $75 as opposed to $58. So if you buy an out of the money option and the stock price moves in favor of your option, the directional exposure or the profits that you'll make for each subsequent $1 change will grow. And that's why traders like to buy out of the money options. And this is even more exaggerated when you go to short-term options, which is why traders love to buy short-term options, is because you can pay virtually nothing for them. And if you get a huge movement in your favor, then you can get 100x, 1000x returns. So if we can imagine a scenario where, let's say I buy this 900 call in Tesla with 1 day to go, Tesla has to go up over $100. But let's say I buy, let's see here. So this 900 call has a delta of 0.02. So if I buy this 900 call in Tesla with 1 day to go and Tesla goes up by $1, I'm expected to make 2 cents on this option, which would be a $2 profit. But it only cost me $36. So let's say I wanted to buy 1,000 of these options. If I bought 1,000 of these 900 calls for $35,000 and Tesla went to 950 for some reason before tomorrow's expiration, then these 900 calls would be deep in the money. And at 950, these calls would be worth $5,000 each. And if I own 1,000 of them, then I just made $5 million. So that's why people like to buy out of the money short-term options, is because you get that extreme gamma in your favor, meaning right now this 900 call has a delta of 0.02. But if it went to 950, then the delta of these calls would be probably close to 1.0, which means instead of making $2 for a $1 increase in Tesla, I would make close to $100. So that's why people like to buy really short-term out of the money options, is because they're virtually free, but that comes with a high probability of losing all your money. But if you're right and something crazy happens, then you can make a lot of money very fast. But in more cases than not, you're going to lose all your money. So that's why I like to go longer term. One person asked, hi, what is ITM? ITM is in the money. So that means an option that is in the money or an option that has intrinsic value. So an in the money or ITM call option would be any call option where the strike price is below the stock price. And an in the money or ITM put would be any put option where the strike price is above the stock price. So I talked about that in my options trading for beginners video. I would recommend watching that, as I cover a lot of the basics that you'll need to know when trading options. Will this live Q&A be posted on YouTube for later viewing, listening? I sure hope so. This is the first live session I've ever done, so I'm kind of figuring it all out. I'm doing this through Zoom, so I'm hoping that it records it for me and I can post it. But I would like to do a lot more of these in the future, just because it's a much easier content format for me than sitting down, recording videos, editing the videos, and I can actually interact with you all and answer questions that the viewers actually have. Laurent asks, if I buy an option and I am, for example, $10,000 in profits, but the contract is still going for a month, can I sell it, or how does it work? I am confused. So they're asking if you buy an option and you have a $10,000 profit and it has a month left until expiration, can you sell it or how does it work? Yes, you can always sell an option before expiration. This is a good question because a lot of people have difficulties with options having expirations. They think that you need to, they think that you need to have, you need to hold the option until expiration. And the answer is that you do not need to hold it until expiration. You can always close an option before expiration. Let's see here. What is the fastest way to close out a position when in profit? In other words, do you ever have issues when getting filled? I just did a video yesterday on getting filled on trades. I mean, sometimes, yeah, I don't always get filled on trades the first time I send an order. Honestly, very rarely do I get filled on the first order that I send, which is why I did the video I did yesterday, which was how to get filled on trades. Basically the strategy that you can apply to any strategy or any option position that you have is if you are buying an option position, whether it's buying a call option by itself, buying a call spread, or buying back an iron condor that you previously sold, what you want to do is you want to look at the mid price of that strategy and you want to try to buy it back for slightly less than the mid price, particularly if the bid ask spread is wide. And if you don't get filled on that initial order, then I would cancel the order, adjust your order price slightly higher, and then send it again. So if you don't get filled initially, then you just have to change your order price to a more unfavorable price for you, meaning that if you're buying a position, you need to pay a little bit more for it. And then I would just adjust your order price by 5, 10 cents, depends on the bid ask spread, but change it incrementally, send it again. If you don't get filled, change the order price again by a few pennies, send it again. If it doesn't get filled, then you just have to keep repeating that process until you find a price that you can get filled at. Generally speaking, you should be able to get filled near the mid price, but sometimes you will need to go a little bit away from the mid price, meaning a little bit more unfavorable for you relative to the mid price. So if, let's say, the mid price for a strategy is 250 and you try to buy that position for 245, you don't get filled, cancel it, go to 247, cancel it, you don't get filled, go to 250, which is the mid price. Maybe you don't get filled, then go to 252, you don't get filled, then go to 255, and then maybe you get filled there. So maybe you have to go a little bit more unfavorable than the mid price, but you can always get filled. And if you are rushing to get out of a position, which is something that is more of a defensive mechanism. So if you're in a position where you want to close it right away because it's a losing position and you just need to stop the bleeding, then my first order will generally be unfavorable for me and it will be away from the mid price. So let's see here. Let's say I shorted a call option in Tesla, and of course that position is not doing well. Let's say I shorted this 800 call option and I want to buy it back. So let's just imagine I have a short position in this 800 call, which means to close it, I need to buy it back. So if I click on buying this call, if I wanted to get out of this position immediately, the mid price here is 103.45. I would probably do something like this. I would just go like this. I would go essentially right to the ask price, or maybe just slightly higher than the mid price. And you can see here on the bottom, it says the mid is 103.35, but my order is at 103.65. If I sent this order, I I would get filled immediately. And so what I would recommend if you're trying to close a position because you need to stop the bleeding, meaning that it's a losing position and you need to get out of it right away, I would not play the order filling game that I described earlier, which was trying to get the best price more favorable than the mid price. I would just go to something that is more unfavorable than the mid price, meaning that if you are buying it to close, you need to go higher than the mid price. And if you're selling it, you need to go lower than the mid price. So if this is a defensive exit, meaning you need to get out fast, then you need to go to whatever the mid price is. So for example, if I was buying back this 800 call, the mid price is 102.35. I would just click a couple ticks higher and I would send it. And I'm okay paying $20, $30 more than the mid price because I need to get out of the position. The $20 or $30 that I spend over the mid price is probably going to be much better than the hundreds or thousands of dollars I could lose were Tesla to be in some crazy run up and I was trying to get filled at the mid price, but every time I sent it at the mid price, the stock price was higher and therefore the option price was running away from me and the losses were building. So there's definitely a difference between closing a trade defensively when you need to get out fast, in which case I would just recommend just give yourself a price where you're going to get out fast, which is going to be higher than the mid price if you're buying it or lower than the mid price if you're selling it. But if you are just trying to casually exit a position, then I would, of course, recommend trying to get the best price available to you. Screw business school. Yeah, I agree. It's funny because I studied finance in college and I did take, I'm not going to say it was all useless. I mean, I think it is definitely valuable to go through the motions of going through some sort of business or finance school, just because then the ideas are at least in your mind and you can be aware of them. So for example, I don't use time value of money every day, but I understand the concept and I understand that it exists. So in the future, if I need to understand time value of money a lot better, then I know what I need to look for and I can go ahead and study time value of money more. But if I never went to that school and I've never heard of time value of money, then you don't know what you don't know. So I do agree that obviously in most cases you don't use a lot of what you learn in school, but it is still useful to go to school and get an education and understand at least what the topics are that you could know and master, and then just be aware of them should you need them in the future. But I did take a options and derivatives course in college, which is directly related to what I do now. But even then, it wasn't, those types of courses are not what we're talking about here. They're usually pricing derivatives, pricing futures, and just kind of understanding the deep mechanics of how those products work. It's not necessarily strategy like we're talking about here. When is the Tesla crash though? It's wild. It's a good question. I don't know. Morgan Stanley just upgraded them the other day to $810 a share. I believe it was Morgan Stanley. So Tesla is one of those stocks where it was highly controversial. People thought it was absolutely worthless. And then you had people like ARK Invest, Kathy Wood from ARK Invest, who they're the biggest Tesla bulls. And, you know, you have those two polar opposites where some people love it, some people hate it. But, you know, Tesla's been delivering. And I think Wall Street's starting to come around publicly to Tesla. So I don't know when Tesla's going to crash, but yeah, I mean, I agree with you. It definitely could crash, which is exactly why I have been hedging that position, because it's been such a profitable position for me. Did you read any books for options trading? Yeah, I did. I mean, when I started, I read a bunch of books. I can't recall the names of them, but the big ones are Sheldon Natenberg's book, Option Volatility and Pricing, something like that. That's a pretty heavy book. There's a lot of dense material in that book. There's a lot of math, but that's one of the most frequently mentioned books. One book that I really liked was How to Price and Trade Options by Al Sherbin. And that's just because I know Al personally, and I always liked the way he taught things. For those of you who don't know, I used to work at Tastytrade. So did Al. And when he was there, I always loved the way he explained things. And so when he came out with his own options trading book, I devoured that, and I thought it was a nice one. But I will say you are going to learn way more actually trading options and, you know, putting some money at risk than you will ever reading books, because you can read as many books as you want. You can read as many blog posts as you want. You can watch all my YouTube videos. But at the end of the day, you're going to learn way more by actually trading. And the way I would recommend going about it is to always ask yourself why. So I think that's why I learned so fast, is because I was never interested in just memorizing things. I always wanted to understand why. So for example, if I say the break-even price of a call option purchase is the call's strike price plus what you pay for it, I didn't want to just memorize that formula. I wanted to understand, why is that? And the answer is, if the stock price is at the strike price plus the premium you pay for the call option, at expiration, the call option's intrinsic value will be equal to your purchase price, meaning the direct benefit of owning that call option will be equal to your purchase price. And for that reason, you will have no profit or loss. So instead of just memorizing things, I would go about it in the way of, you put on a position. And when you're a beginner, I would really recommend experimenting with lots of different strategies. And you can even go shorter term. I typically trade 60 days to expiration, longer term trades. But when you're learning, I think it's beneficial to actually go shorter term. So you could trade like weekly butterflies, weekly credit spreads. Just make sure you're trading small, you're not risking a lot, because a lot of these positions, especially short-term positions, they can go south very quickly. And I would trade those short-term positions, and every single day I would look at, okay, what happened to the stock price and what happened to the profitability of my position? And why is my position profitable today? Why is my position losing today relative to what happened with the stock price? And then also with how much time has passed. You want to just ask yourself why. And you want to go down rabbit holes, and you want to just figure out, okay, why is this? And then once you figure out the answer to that, maybe you'll have another question, and then you need to get to the bottom of that question. So learning options, it's a very complicated field. There's a lot to know, obviously, which is why I'm able to have an entire YouTube channel dedicated to it. But I think if you ask the question, why is this happening? And then you try to seek the deepest answer, and then you keep following your questions, and you use that same approach to all your questions, eventually you're going to have a really deep understanding of everything. And I think that's the goal. I've been doing this for 8 years now. I know a lot. I would consider myself an expert, but I understand that there's still a lot I could learn. And so whenever I have something where I'm kind of confused by, I use that same approach. I ask the question, why is this? And then I seek to understand the deepest understanding of it, as opposed to just memorizing stuff. What's it like to work for Sauce Grande? It was great. So I will always be extremely grateful for the opportunity that I had to work for Tom. Tom's impact on me is much bigger than just working for him. People that watch Tastytrade, they don't necessarily get to interact with Tom personally off camera, but Tom is one of the nicest people I know. He's extremely genuine, and I'm very grateful that I was able to work for him. What do we got here? Chris, why don't you start a Patreon? It would be a really great platform for aspiring traders. Honestly, I don't really know a lot about Patreon. One thing I will say is that I am a one-man show. And one thing I've learned since starting Project Option is that when you have an online business, there are so many different things that you can do. I could be focusing on my website. I could be writing blog posts. I could be creating courses. I could be doing YouTube videos. I could be doing webinars. There's so much that you could do. But for me, I have very limited focus. And so I decided a long time ago, once I saw the growth on YouTube, that I was going to focus on YouTube because I saw the most consistent and exponential growth on YouTube. And for that reason, I decided my efforts were best put into YouTube. So maybe I'll have a Patreon one day, but not right now. I like to keep it focused. Hello, Chris. I'm new to options. I'm paper trading. How do I sell a call option? Expiration is tomorrow. How do you sell a call option? Well, let's go to a different stock. To sell a call option, and this is confusing because when I say how do you sell a call option, I'm talking about shorting a call option, which means you're selling it without owning it first. This is a very confusing topic for beginners because how do you sell something that you don't own? Well, when you sell something you don't own, in options, you can buy something you don't own. You can also sell something you don't own, which is called shorting it. When you sell it, you're betting against it. So if I wanted to sell this or short this 125 call in Apple, the way you do that is you click on the bid price here. So the bid price is the highest price someone is willing to pay for an option. The ask price is the lowest price someone is willing to sell that option for. So if I want to sell it, I have to go to people who are willing to buy it. So to do that, I click on the bid price for this 125 call, which is 585. And you see when I click on the bid price, it brings up this red box. And this is indicating to me that I'm setting up an order to short or sell this call option. If I already own this call option, then this would effectively be selling it and closing the position. But if I don't have the position in this, which I don't, then it is shorting the call option. So the first thing, you just click on the bid price, and this is pretty standard across all trading platforms. Click on the bid price, but as you can see on Tastyworks, this red box comes up and it says S1, and this means I'm trying to sell one of these contracts. So if I increase the quantity, you can see it says S11. That means I just changed it to selling 11 of these, but let's keep it at 1. And then once you do that, if I'm okay with this, and the buying power effect for this position is $7,000, which means I need $7,000 of available buying power or margin to put this position on. So since shorting a call option is a risky position because there's no limit to how high the stock price can go, then I need to actually put up collateral in case the position starts to have heavy losses. And so if you have the $7,000 available and you're ready to short this option, we can see that the bid ask spread here is 580 to 590, which is really, really good. So I would go right for the mid price of 585. And now it's bouncing around a little bit, as it always does. But if you're ready for this, then you just click review and send, and then you send the order. And if you get filled, then you have successfully shorted that call option, which means you sold it without owning it first. When is the responsible moment to start considering trading options full time? This is a good question, and you might not like my answer. So to trade full-time, meaning you're going to quit your job and you're going to trade full-time, I think you have a pretty substantial list of prerequisites. The first being you have a track record, multiple years, ideally like 5 years of having positive returns. And depending on what those returns are, I think you need to be conservative with your expectations for your returns going forward, because you can't go into trading full time assuming you're going to make 50% a year. I would base the numbers off of, okay, can I make 10, 15% a year trading? And then from there, you can kind of figure out what your numbers need to be. So if you're making 15% a year trading, then what does that mean for how much money you need to make? How much money are you trying to make every year? If you're trying to make $100,000 every year based on a 15% return, then you need to have about $700,000 making 15% a year. And that's just going to get you your 100K revenue. Then you have to take out taxes. So let's just call it, you pay $20,000 in taxes. So if you have $700,000, you make 15%, you pay $20,000 in taxes, you're going to be left with about $80,000. This is just very rough math. This is not specific, but based on those numbers, like, you need to have a really big account and you need to be hitting your return targets to actually trade for a living. And the big problem I have with trading for a living is that you're trading for a living. And so it's going to be a very stressful event. Okay. It's going to be very stressful to be trading and knowing that you need that money, because if you need the money and you're trading for it, then you're going to be more emotional. So before even trading for a living, I would say that you need to have a systematic strategy that you're following. You can't be trading for a living and saying, okay, I think Apple's going to go up this month, so I'm going to buy a call spread. I think Tesla's going down, so I'm going to buy a put spread. It needs to be a very methodical strategy. So you need to have a written out strategy with very specific rules and sizing requirements that you can follow, which will keep your emotions in check. And you need to have a lot of belief in that system to continue working. So I think there's a lot of things that go into starting to trade for a living, and it's a very difficult thing to get into. You can definitely do it. Some people make a lot of money trading for a living, but the prerequisites are steep. For some reason, options take so much margin that sometimes it makes no sense. How to manage that? That's a good question. All right. So let's get back to this Apple example. Let's say I wanted to, let's go out a little bit. I need to go February. Let's go to the February expiration cycle. So 43 days. What's Apple been doing? All right. So look at this. This is kind of how, if you want to be technical with your trading, this is exactly what I would do. If you are bearish Apple, as we can see here, Apple had a big run up to 120 or 130. And well, this is 137. And then it crashed, and then it came back up, and then it had another top at 135. So it kind of had this double top pattern here. If you think that Apple is going to fall from this again, then maybe what you would do is maybe you would short the 140 call option. And let's do that through February. So let's go to the 140 call option. I'm going to short this. So I'm going to click on the bid price as we discussed earlier. And this sets up an order to short the 140 call option all by itself. The buying power effect for this is $5,600. Okay. So maybe you want to reduce that. One way you can really reduce that is you can buy another call option at a higher strike price, and you can go to a very cheap option, say the 180, and that reduces my buying power requirement. But I only reduced my profitability by $37. So instead of just shorting the 140 call by itself, let me cue that up again. If I sell the 140 call by itself, My profit potential is $340. My buying power requirement is $5,600. But if I purchase the 180 call as well, now my profit potential is $305. So it's $35 lower than it was before. But now my buying power effect is $2,000 less. So the way you get around buying power requirements is you don't short naked options. You buy a cheap out of the money option and create a spread. So you just trade a really wide spread as opposed to shorting naked options. And I would always recommend to do something like this. Even if you purchased the 200 call or whatever, it makes sense to just pay 20 cents, pay $20 for this option. Just give yourself disaster insurance. It's always worth it. The number one rule of options trading, don't blow up. And the way you blow up is by shorting naked calls. Holy moly, I didn't know you do live streams. I don't. This is my first one, but I'm having fun with it and I like it. So this is going to be something that I'll do much more often, because I'm sure you've seen that sometimes when I upload videos, I don't upload another video for quite some time. So to do live streams it's really easy for me, and it's nice because I get to talk to you all and I get to answer questions that you actually have instead of me trying to come up with a video to answer questions that I think you have. I can just go straight to the source and knock out a lot of questions right away. And this is a very easy content format for me because I just hit record. I'm just talking. We just go through it. I don't have to spend 10 hours editing a video. Chris, you should write a book. Maybe. I'm not there yet. I think I could write a book, but I'm not in the mindset to write a book right now. That's a lot of work. It's a lot of writing. Honestly, if I put all my blog posts on my website into a more organized format, it could probably already be a book. Why is it hard to make money buying calls and puts in a short term? So in a short-term expiration cycle. Let's go back to Apple. A short-term expiration cycle would be January 2021. So this has 8 days to expiration. Why is it so hard? Let's see. Excuse me. So if I went to this 8-day expiration cycle and I bought this 135 call, I'm going to pay $100 for it. There's only 8 days to go. So if I buy this 135 call, with each passing day, this option price is going to go towards zero if Apple stays at 130, because this 135 call option does not have any intrinsic value, which means if I buy this 135 call, I own a contract that allows me to buy 100 shares of Apple at $135 per share. But that has no real value when Apple is at 130, because I can just buy 100 shares at 130. I don't need this 135 call. But the reason that the 135 call is worth $100 right now is because it has 8 days left until expiration. And there is a probability that Apple will be above 135 at expiration, in which case this option will now have real value. So if I buy this 135 call for $1, my break even is 136. I need Apple to be at least $136 in 8 days to make money, or just to break even on this trade. I need it at 136. To double my money, I need it at 137. So there's only 8 days left. And if I buy this 135 call, to double my money, I need Apple to go to 137. This is talking at expiration. In 8 days, Apple needs to be at 137, and this call option will be worth $2. Now, as we can see, Apple's at 130, so it needs to increase by $7 in 8 days. Otherwise, I'm not going to make money. All right. In that scenario, I'm not going to double my money. To get to the break-even price, it needs to go to 136. So in 8 days, it has to go to 136. And so if you can imagine a scenario where I buy the 135 call and Apple just sits at 130, this option is going to lose value every single day, because the probability of this call option having intrinsic value at expiration decreases with each passing day. So to get to 135 in 8 days has a certain probability. To get to 135 in 6 days has a lower probability, meaning a lower option price. And to get to 135 in with 4 days remaining, if Apple's still at 130, that's an even lower probability. So I can actually simulate the decay of this option if we look at the same option, the 135 call, in a shorter term expiration. So remember, 8 days to go, the 135 call is worth $1. What is it worth with 1 day to go? The 135 call with 1 day to go is 15 cents. So if you can imagine buying the 8-day 135 call for $1, or you pay $100 for it, and now there's only 1 day to go and Apple hasn't moved, it's still at 130. Well, this option is now worth $15 and you've lost $85. So it's very easy to lose money buying short-term options, particularly out of the money options, because there's no room for error. You need everything to go right immediately. You need the stock price to continue going up. Okay. And that's why it's really easy to lose money when you're buying short-term options. What up, G Money? Do you scalp options? Not really, no. I will admit earlier last year, I should say, March, April, when the market was extremely volatile, I was very active. I was over trading for sure. And one thing I've noticed is that whenever markets get really, really volatile, it's very dangerous for traders because things are moving around so much. And with a lot of movement comes a lot of perceived opportunities because you think, well, if I buy this put option today and SPY is down $10 tomorrow, I could make a killing. And so you make a lot of those little trades. And then before you know it, you've churned a lot of commissions. You've lost a lot of money because you were wrong on those short-term movements. And so for that reason, I do not like scalping. I think if you have a strategy and you have a rules-based strategy, then scalping is much more of a thing. But if you're just winging it, I would not recommend it. And as I said just now, I would be very careful in really volatile markets because things are moving around so much that it's very easy to start over trading because you see all these things moving around. There's so much opportunity to make quick money, and that can pull you in. And it did pull me in earlier in 2020. I was over trading and I actually was down a lot of money. And then I got much less active and just had these positions that I just let them sit. And 2020 ended up being the best year that I've had. The main account that I had increased 100% after being down 30% in March, April. So from down 30% to up 100%. Down 30% was super active, up 100% was pretty passive. So I would, one thing that's very difficult about options trading is that you want to be really active. And I think when you're learning right in the beginning, it's okay because the more activity you have, the faster you're going to learn because you're going to see more scenarios. But as you get more experienced, I would highly recommend being more passive, being more patient. It's my best advice because that's the hardest thing to do is to look at something and not do it. You don't know how many times in 2020, especially after March, April, where I looked at something and I said, this looks really enticing. And then I didn't do it. And I think that is a very, very valuable skill to develop. And it's essential to your survival as an options trader is developing patience and discipline to sit back and do nothing when you really feel like you want to do something. How do you protect against these volatile markets? Volatility products, different contracts, and same underlying or cash on hand to react to a downturn. The way I look at it And the way I've looked at it in the portfolios I have, this is the main portfolio, but I look at it in terms of position sizing. So what positions are the largest? Meaning, if a market correction were to happen, which positions pose the largest risk to catastrophic loss? If I sort by net lick, and I would recommend setting, if you use Tastyworks, I would recommend setting up your columns like this. You can do that by clicking on this gear symbol. If you go to accounts and positions, if you go to displayed, you can change the columns. These are all the available columns you have. But I like days to expiration, trade price, which is your entry price, mark, which is the current midpoint of the strategy, P&L open, which is essentially the difference between those two, P&L day, which is how much you've made today, net lick is how much the position is valued at. So if I were to completely close a position, how much cash would I get? And that is what I'm basing this off of. So if I sort by net lick, I can see that the largest position in the portfolio is Tesla, and it's over $100,000 now. So this is, if we look at all the other positions, this is by far the largest position. So this is the most important position to pay attention to in the whole portfolio. If I don't manage this position carefully, it could be very bad. If I don't hedge this position and it decreases by 50%, then I just lost $55,000. And that's not something I want to happen. So with your largest positions, those are the ones that you need to pay attention to. These other positions down here, like Facebook, these are just shares, a lot of them. But I don't need to really protect against these positions, because if for some reason Facebook went to zero, I would lose $7,000. And that doesn't mean anything in the context of these other larger positions. So a really high concentration in a couple positions, which will naturally happen if you put on positions and they really work out for you and become really profitable, as these have, then you're going to be in a situation where you have a lot of exposure. And I'm not going to just close this Tesla position because it's a long-term play. I'm still a believer in it, but I understand that there are risks. And since it is the largest position, I am being very careful with this. And that is exactly why the other day I rolled up my put. So I had the 500 put in February, and as Tesla has increased, I rolled it up to the 650 put. Okay. And the reason I did that is because I want to protect against further losses. So if Tesla were to go to zero, then at least this 65 put, or the 650 put here, will be a very good position to have. So in the crazy event that Tesla went to zero, then this 650 put would be worth $65,000. And basically that would represent a slightly less than 50% loss. But if I did not have this protection, Tesla went to zero, then I lose this whole thing. And so the way I'm managing this, and the way I would recommend managing your largest positions, is to just focus on those large positions and be very careful with those, and make sure you have disaster protection in those positions, particularly if they are extremely profitable, because you don't want to have a scenario where you see a really profitable position go back to nothing, because that's going to hurt and you don't want that. So the way I would hedge positions in your portfolio is focus on the largest positions that you have, especially if they started much smaller and they're extremely profitable now. I would focus on those positions and just hedge those few positions. But that's assuming that you have a portfolio with kind of high concentration in a couple positions. How do you reduce your taxes on capital short-term gains? You really can't. Lock in some short-term losses. Do you think it is a good idea to trade lots of different positions? If you are a beginner and you're learning options, I think it is good to trade lots of positions, because you can monitor lots of different positions, particularly if they're different strategies, and then you can learn very quickly from those positions. But as you get more advanced, I would say that you need to be careful of the positions that you have and how they overlap. So an example would be, I don't think it's a good idea to trade 10 different stocks and sell an iron condor in 10 different stocks, because in the event of a market collapse, all 10 of those iron condor positions are going to lose money, because all 10 of those stocks are going to fall with the market. And just because you have 10 different positions, it does not mean you have diversification. What you really have is one larger iron condor position. So always consider how the positions in your portfolio will perform together in the event of a big market sell-off. Generally speaking, the more volatile the market is, the more correlated everything is. And so if you're looking at something like March, April of 2020, every stock was moving together. But as volatility gets lower, then things start to kind of move on their own. So that's a generally accepted idea, is that the higher the volatility in the market is, the more correlated everything is. The lower the volatility in the market, things have lower correlation. But you can't over-index on that low correlation and think that you are diversified, because what you need to pay attention to is, what if these things become highly correlated? You need to watch out for that. So yes, I think it's good to trade a lot of positions when you're a beginner, because you're going to learn a lot. And I would recommend trading lots of different strategies in those positions. And as I said earlier, observe those positions every single day and figure out why they're profiting, why they're losing money, and ask yourself why. Why? That's the main question you need to ask, is why. But as you get more advanced, I would be careful trading lots of different positions in a portfolio, because everything is going to get correlated in the event of increased market volatility. And then lots of your positions that you thought were independent of one another are now working together. And now it's essentially just one larger position. Chris, what's your best strategy from last year? Long Tesla calls and call spreads. Let's take a look. So Tesla, I open up Tesla. This is a column I love on Tastyworks. It's called D's Open, which is days open. And this tells me how many days I've had each of these positions. So you can see a lot of these have been over 100 days. So over 3 months, 4 months, 5 months. If we look at these 500, 600 call spreads, we can see that the 500 call is up 160,000, but the short 600 call is down 145,000. So this is a call spread. So when the stock price increases, you will have more profits on the lower strike call than you will have losses on the short call. And if we take the difference between these two, that gives me a profit of 15,000 on this call spread position that's been open for 160 days. This 900 call option I bought for $100, so 10,000, and that was 3 months ago. Now the call option is at $30,000, so it's tripled in value. That's made $20,000. This 700, 800 call spread, I talked about this in one of my How I'm Trading Tesla Options videos. This was actually a trade where I bought the 700 call on one of the trading days, and then almost immediately after I bought this call option, Tesla had a big run up, and I was able to short the 800 call option for the same amount. So I paid $11,800 for the 700 call, and then 30 minutes later, I shorted the 800 call for $11,800, turning this into a risk-free position. Because if these options expire worthless, I will lose $11,800 in the 700 call, and I will make $11,800 in the short call, and I will have no profit or loss. So I've just been holding this because now Tesla's at 800. So this call spread is actually fully in the money. Let's see what it's valued at right now. The maximum value of this call spread is $10,000. So I have a risk-free call spread position, meaning I can't lose any money on it based on my entry prices, but the most it could be worth is $10,000. So I could make $10,000. And currently I am up $3,000 on it. And I know that because I'm up 18.8K on the long call and I'm down 15.5K on the short call. So if I click on these two and I click close position, then we can see what this call spread is actually valued at. And right now it's at $33. And I just said that the maximum value of this call spread is $100. So the width of the strikes. If Tesla is above $800 in 500 days, this call spread will be worth $10,000 or $100. So since it's currently valued at $33 and it could go to $100, I still have $67 or $6,700 of profit potential in this call spread if Tesla is above $800 in 500 days. So basically I just have to wait. And if Tesla remains above 800, this call spread's value is going to go from 3,300 and it's going to steadily approach $10,000. So those were my positions. But also let's not forget about the shares. So I have 70 shares of Tesla that were purchased at $211 and now they're at $800. So the stock position is actually the most profitable portion of this whole thing. Tastyworks is my trading platform. Do they send the 2020 tax info or do I have to download it? Generally, after the year is over, typically you'll have to wait a month or two. So you might have to wait until February or so for all your tax documents to be uploaded. But you can find your tax documents, like no matter what trading platform you're using, you should be able to find it on their website. And there should be a tax document section. And once they upload those, you can download those to your computer and then you can use those when you file your taxes. Your thoughts on NIO options? I haven't really been trading NIO. I don't really know much about NIO. Do you think this market rally will continue through the week? I have no idea. This is an interesting chart. Who knows? I mean, the end of the week is tomorrow, so probably. I don't like predicting short-term movements. I have in the past, and I've definitely done trades. I have some videos on the channel where I've done short-term trades, but generally speaking, the more short-term you go with your predictions, the more it is like gambling. The more it is like a casino. The longer term you go, the more predictable it is. But of course, you can't predict anything with 100% certainty. But what I do know is that the shorter term you go, the shorter term your trades are, the more it is like gambling. So if you think, if I do a 30-day market prediction, I probably have well, maybe not 30 days. If I have a 1-year market prediction, I probably have a better chance of being right on that compared to a 5-minute market prediction. So the shorter term you go, the more it is like gambling, and just keep that in mind. Are you trading SPX 0DT options? And if not, why? I talked about that earlier. I am not. I don't think it's a good idea. Well, personally, I don't like it for the reasons I mentioned earlier, which is basically the SPX settlement process. Assuming you're trading the monthly SPX options, they settle in the morning to a number called SET, which can come out at a very different number than where SPX actually opens on the morning of settlement. And for that reason, you can have nasty surprises. So I do not trade 0 DTE SPX options. Do you file your own taxes or do you work with an accountant? I file my own taxes, but I probably should get an accountant here soon. It's getting more complicated. On the Tastyworks option chain, can you change more than 2 things in the header? No. Right now you can only do 2. So what they're saying is, can you add more columns here? So you can customize these. So right now I have open interest in Delta. I can change this to volume. I can change this to EXT, which is extrinsic value. You can only use 2 though right now. So you can only look at 2 things. You can't add more. They might change that in the future where you can add more columns. Tips on bull put spreads. Sure. I got to get off soon though, guys. I thank everyone for coming in and chatting with me, but I got to head out soon. Let's go through tips on bull put spreads. Let's go back to Apple. First thing is, I'm not a very technical trader, but I do look very loosely at charts. So if I'm going to do a bull put spread in Apple here, what would I look at? Well, you can kind of see it's kind of trading technically with this pretty steady uptrend. I would look for a low or a dip like this. So like 120, 110, see these little lows here, maybe 120. You can't always use this because sometimes the lows that you're looking at, they might not have good option prices or the options will be too cheap. So for example, if we looked at this 120, let's say I think Apple is going to remain above 120 through February. I go to the trade page, go to February options. If I look at the 120 put, I can sell that for 285, which is, it's not a lot because it doesn't really give me a lot to work with when creating a spread, which is I have to purchase another option at a lower strike price. Let's say I wanted to buy the 110. Then I would be selling this 120, 110 put spread, which is a bull put spread. Since this is a bullish strategy, I want the stock price to be above 120 because if it is, then the 120 and 120 puts, the 120 and 110 puts will go out worthless and I will basically have a 100% profit on this spread. The problem I have with the strategy is that the maximum profit is $173 and I can lose $830. And one thing I did different in 2020 was I focused more on asymmetric return strategies, meaning I chose strategies where my loss potential was limited, but my upside potential was far less or far more than my loss potential. So that's what we call asymmetric returns. You can only lose $1, but you can make $5, $10, whatever. Basically, that means long calls or a really wide call spread. So the problem I would have with this 120, 110 bull put spread is that you can only make $173, best case scenario, but worst case scenario, you can lose $830. And that's tough for me psychologically because I know if I have a full loss, then I need a handful of these trades to go perfectly before I get my money back. So instead of doing the 120, 110, maybe I would move this to 130, 120. And now my risk to reward ratio is a little bit better because I'm getting closer to the stock price. So maybe you revise what I just said. Instead of saying you think Apple is going to be above 120, maybe you get a little bit more bullish and you say, okay, I think it's going to be above 130 in February, which if you look at this, you could argue that it looks like it's going to continue going up, maybe even break through this high. But the big problem I have with credit spreads is that if you go too far out of the money, your risk to reward is really poor. So for this, I would rather get more aggressive and do the 130, 120 and have $400 of profit potential and $610 of loss potential instead of the 120, 110, where I would have half of the profit potential and more risk, but a higher probability of making money. One thing you have to understand is everything in options trading is priced based on a probability. And since there's a higher probability of this spread being fully profitable at expiration compared to the 130-120, since this spread has a higher probability of being maximally profitable, it has more risk and less reward. But if I go to the 130-120, there's a lower probability that Apple is above 130 compared to 120 in 43 days. And for that reason, there is a lower probability that this put spread is maximally profitable at expiration. And what that means is, since there's a lower probability of it being maximally profitable, it has less risk and more reward because it's a lower probability strategy. And the same can be said about if you just look at any call option purchase. If I look at the 130 call purchase, basically Apple needs to be above 137 for this to break even at expiration, but it has $700 of risk and unlimited profit potential. However, if I go to the 150 and I buy this for $1.60, then I need Apple to be at 150, 160 at expiration, which is higher than 137. And since there's a lower probability of this breaking even or making money at expiration, it has a lower value associated with it. There's only $160 of risk, unlimited profit potential, but it has a higher probability of losing money compared to buying the 130. So you pay for probabilities in options trading. If you're going to do a really low risk, high reward strategy, you're going to have a low probability of making money. If you do a lower probability, if you do a higher probability of not losing everything, then you will pay more for it. And that's going to kind of eat into your returns. Another way you can look at this is, some people ask when they're learning about vertical spreads, they'll say, okay, if I buy a call spread and I want the stock price to be above the short call at expiration, then why don't I just buy a call spread that is in the money? So if Apple is at 130, why don't I buy the 100, 120 call spread? And the reason is, if you look at the price of this spread, the maximum value of any vertical spread is the width of the strikes. So this is a $20 strike width. The maximum value of this call spread at expiration is $20. This call spread right now is trading for $18. So if I buy this for $18, or let's just change it. If I buy this for $18, my max loss is $1,800. My max profit is $200. So I have very little profit potential on this and mostly loss potential. And that's because this is a high probability win strategy. There's a high probability that Apple remains above 120 at expiration because it's already at 130. And so I get mostly risk and very little reward for this compared to if I bought an out of the money call spread. So the reason you don't really go to the obvious answer, which is, well, if I need the stock price to be above the short call, why don't I just buy an in the money call spread? It's because you're going to get mostly risk and very little reward. If I were to move this, which there's a cool feature on Tastyworks, if you set up a spread and you use this bottom left-hand strike thing, you can just move both the strikes at the same time. So if I click the down arrows, it's going to move the strikes downwards. So let's start at the 100, 120. And this spread is at $18. As I move the strikes higher, meaning the spread has a lower probability of being maximally profitable at expiration, we will see that the cost or the risk associated with this position will get lower and the reward will increase. So if we continue to click down, we can see that the maximum profit is increasing, the max loss is decreasing, because as I shift these strike prices higher, I'm choosing a lower probability, more aggressive call spread. And for that reason, since it is a lower probability strategy, I will have more reward potential and less risk. So if you bought the 150, 170, you need Apple to be above 170 for this call spread to make money in 43 days. And since there's a very low probability that Apple is above 170, you're going to have the opportunity to make $1,900 and your loss potential will be $100. So everything in options trading is based on probabilities of making money. Every strategy's price is based on a probability. I'm new to trading. I don't even know the concepts. How should I start? I would recommend watching my 3-hour video called Options Trading for Beginners. It's got almost 5 million views now since May of last year. It's been very, very successful, and basically everyone who has watched that video start to finish learned a ton. So I would definitely recommend watching that video. And it's neatly sectioned out, so you don't necessarily have to sit down and watch the whole thing in 3 hours. You can watch specific sections, and everything's timestamped on the playhead and in the description. So you can stop at a certain section and then, watch 20, 30 minutes at a time and then pick up where you left off. But I would highly recommend watching the Options Trading for Beginners video. All right. I'm going to head off. This has been fun. Today was kind of a test run for options trading Q&A. I actually really liked this video. I like doing this because I get to answer a lot of questions. And when I'm making videos, a lot of times I kind of get caught up in engagement, because on YouTube, engagement is everything, meaning how do you keep someone watching? And for that reason, sometimes I over focus on what can I do or what can I show or what can I say to keep people engaged, as opposed to a much more casual format like this, where I can just speak my mind and just share everything that I've learned with you all. So later, my bald brother. Yeah, I need to increase my bald. I got to shave. So yeah, thanks everyone for tuning in. I'm going to see if I can upload this video. I hope I can, because I feel like there was a lot of good questions here, but if not, then I'll figure out how to get the next one uploaded and we'll go from there. I'll try to do these pretty often. I think I could do these. I could do these once a week, easy. So happy trading, everyone. I enjoy this way more. That's good, because it's easier for me. Happy trading. Happy 2021. And I will see you guys in another video soon.